Welcome back to Alpha Recap. Brittany here, and we're unpacking the big sector themes from the session that just finished. Markets closed with a real split personality on March 17th, and we've got Ben here to walk us through the crosswinds. As always, if you have questions, you can reach us at stockalpha.ai.
Thanks for having me. Glad to be here. It was a packed day. Geopolitical headlines, big capital raises, and pockets of clear momentum across crypto, materials, and real estate.
So, what really stands out here is the two narratives, right? Risk-on flows in one lane and a geopolitically driven oil shock in the other.
Exactly. On one hand, crypto strength and PDAC deal flow pushed materials and parts of real estate and industrials higher. On the other, a jump in oil prices and some regulatory noise hit energy-exposed names and selective tech names.
Let's start with the headline everybody noticed. Oil. Brent topped $100 a barrel after the Iran-related tensions. That's a big move after the close.
Right. That spike was the proximate driver for a lot of the day's risk repricing. When Brent pushes above $100 a barrel, it's not just a commodity headline. It ripples through transport, airlines, and industrial margins. Analysts note the immediate inflation implications are real, and it increased short-term volatility for energy-intensive sectors.
I mean, when you step back and look at this, a sustained move like that could even change central bank conversations if it sticks, right?
Yes, if it's sustained, it tightens margins, raises input costs, and can push core inflation higher. But analysts also point out the move could be transitory if physical supply eventually stabilizes. Still, for the day, it raised risk premiums in credit markets tied to energy exposure.
Okay, shift gears. Crypto. Bitcoin was hovering near about $75,000, and there was talk about regulatory clarification and payments partnerships. Tell me why that mattered to the market today?
That was a pretty constructive combo. The summary guidance from the regulators suggested many crypto assets aren't classified as securities, and then you had partnership activity with payments providers and infrastructure names. Analysts say clearer legal boundaries reduce overhang and make it easier for institutions to engage, which helped risk appetite in crypto-related equities and trading volumes.
Right. So the regulatory clarity acted like a tailwind, while the oil shock was a headwind elsewhere. Interesting contrast.
Yep, it's a classic example of cross-asset divergence on the same day.
Materials and mining also popped thanks to PDAC deal flow and offtake agreements. Walk us through why these offtakes matter in plain English.
Sure. Think of an offtake as a long-term buyer agreement for a mine's output. For juniors and developers, lining up those contracts de-risks revenue and makes it easier to get financing. With electrification demand for copper and specialty metals, securing offtakes can speed up project timelines and tighten borrowing costs. So the sector reacted positively to those headlines.
Makes sense. And real estate. Big moves there too. CBRE Investment Management closed about $2.1 billion for Asian assets. That felt like a vote of confidence in property asset classes.
Absolutely. Large equity raises signal institutional appetite for income-producing real assets. Combined with big industrial and Manhattan multifamily leases we saw, it points to renewed allocation to property markets, especially logistics and multifamily, where occupancy and rents are improving.
Brief reaction? That's a lot of capital chasing bricks and mortar again.
Yeah, that tracks.
Let's talk industrials and the energy transition angle. We had a Tesla and LG tie-up flagged at about $4.3 billion for a battery plant. Plus, the Energy Department announced a $500 million critical minerals program. Big for supply chains?
Very big. These commitments are deliberate moves to secure domestic processing and manufacturing capacity for batteries and critical inputs. That helps reduce supply chain bottlenecks for electrification. Analysts note it's part of a longer-term trend, even as oil volatility creates short-term stress for fossil fuel markets.
And Venture Global. They secured about $8.6 billion for LNG expansion. That's another sizable energy headline, albeit in a different corner of the market.
Right. It underscores the energy market complexity. While oil jumped on geopolitics, LNG financing shows persistent global gas demand. So you've got capital deployed into both fossil and transition projects at the same time.
Got it. Quick reaction segment.
Big move.
Not what anyone expected.
Honestly, I was a bit surprised by this one.
Let's unpack the cross-sector themes people will be talking about after today. First, geopolitics lifting commodities and re-rating risk. We already touched on oil, but how did that feed into materials and other sectors?
When geopolitics raises commodity prices, hard assets and materials usually get a bid because they're seen as hedges against inflation or supply disruption. So materials got momentum from PDAC deal flow and gold and specialty metals updates. But the same shock tightened margins for airlines and transport, which are heavy consumers of fuel.
Second theme, energy transition versus short-run fossil fuel stress. In one sentence, how should listeners think about that?
Think dual track. Short-run winners from higher hydrocarbon prices coexist with structural winners tied to batteries, critical minerals, and electrification capex.
Third, AI and cloud keep their long runway, but selective regulatory and product cycle noise mattered. We saw Microsoft Copilot Health and some AWS and Comcast moves. What's the takeaway?
AI is spreading across sectors, not just headline tech names. That means software, healthcare diagnostics, and industrial automation companies adopting AI can be durable growth stories. But short-term regulatory actions or product missteps can still cause big day-to-day swings in specific subsegments.
Fourth theme, capital redeployment into real assets and industrial capacity. CBREIM, Niron Magnetics potential plant announcement around $1.8 billion. That felt like a structural rotation.
Exactly. Institutional investors are leaning back into tangible assets and supply chain capacity, which supports materials and real estate demand. It's a sign that some allocators are prioritizing income and physical exposure over pure growth right now.
And the fifth theme? Regulatory uncertainty as a drag on niche sectors like cannabis and some media. That was more of a localized headwind than a market-wide story.
Yes, state-level wins for cannabis in some places were offset by federal scrutiny on CBD and hemp THC rules. Same with communications and live entertainment names facing licensing and regulatory noise. Those pockets of uncertainty create dispersion even when demand is okay.
Let's run through the biggest single-day moves that mattered, briefly. Oil spike. We covered that. Crypto strength. Regulatory clarity and partnerships. Materials. Offtake contracts and PDAC. Real estate. Big equity raises and leasing. Industrial. Battery plant and critical minerals funding. Venture Global's LNG financing. Healthcare. NIH spending and private AI biofunding. Anything to add?
Just that each of these headlines carries both near-term and structural implications. For instance, offtakes lower financing risk for miners today and potentially speed production tomorrow. Likewise, battery and mineral funding shore up the supply chain longer term, even if oil markets are noisy now.
Okay, quick practical lens. Analysts offered a few actionable insights for positioning, framed as informational. Talk us through the most useful ones for listeners to consider researching further.
First, monitor commodity-driven inflation and stress test earnings for companies with high energy input intensity under sustained higher oil scenarios. Second, separate short-run hydrocarbon volatility from longer-term transition investments. Two different playbooks. Third, watch regulatory headlines closely as they can create multi-day moves in niche sectors. Fourth, use crypto market structure updates and partnerships as a barometer for institutional adoption. And fifth, prioritize names with secured offtakes or long-term contracts in commodities and real assets because they offer clearer near-term cash flow visibility.
Nice. I think the practical nugget there is stress testing and focusing on contracted cash flows. Short reaction.
Totally agree.
What are the immediate catalysts people should watch before the next session?
Keep an eye on Middle East developments and any shipping or sanction headlines. Those will determine whether Brent's move is sustained. Also watch central bank commentary and inflation prints in case higher energy prices bleed into core inflation. Company earnings and guidance from tech and industrials tied to AI and capex cycles matter. plus any PDAC deal updates or materials offtake announcements. Finally, regulatory rollouts on CBD and communications policy could produce quick repricing in certain names.
A quick clarifier. Analysts repeatedly said sentiment heading into the next session was neutral overall, even with pockets of momentum. Why neutral and not outright cautious?
Because there were offsetting forces, big capital raises and structural investment themes supporting certain sectors, while geopolitical and regulatory headlines created concentrated risk. Those forces roughly balanced out, so momentum pockets exist, but headline risk argues for measured positioning.
Before we wrap, a short reactions block. 2 quick takes from you.
Think in 2 tracks: cyclical headline risk and secular allocation trends.
And my quick take, watch energy input sensitivity across portfolios.
Mm-hmm.
All right, Ben, let's close with 3 clear takeaways for listeners.
First, the oil spike created immediate cross-sector volatility and raised near-term inflation risk, especially for energy-intensive sectors. Second, large-scale capital commitments, from battery plants to LNG financing and big real estate raises, reinforce longer-term structural themes like electrification, AI adoption, and institutional demand for real assets. Third, regulatory headlines remain a key source of dispersion, so active monitoring and stress testing of earnings sensitivity are important. Analysts note these are informational points, not investment advice.
Perfect. If you want to follow up on any of today's themes or dig into a specific sector brief, go to stockalpha.ai. And if you have questions about anything we covered today, head to stockalpha.ai, where you can ask us directly and we'll answer live. For more market analysis and insights, visit stockalpha.ai. Thanks for listening to Alpha Recap. Ben, thanks for the insights.
Thanks, Brittany. Great to be here. Talk soon.